In this video, I'm going to show you how a stock price goes up and down and how it impacts the company. So what you have here is, let's say, a company that has a stock price of $1. And the company has 100 million shares. And based on that $1 stock price, the market cap is 100 million, okay? And let's also say that the company is worth 100 million. So based on the revenues, fundamentally it is worth 100 million. So when you have an efficient market on an efficient exchange during normal times, you should have the stock trading somewhere around the value, because nobody's going to give you a deal, right? It should. So investors who are the owners of the company should buy and sell this stock around that level. And so then you will have like a bid and ask. So let's say a bid is like you're bidding for a house. You're bidding for the stock. So you might say, okay, I am bidding 1,000 shares at a price of 90 cents, and then somebody else is asking for the shares to be sold. So that person might say, well, I want to sell 2,000 shares for $1.10. So the difference between the ask and the bid is the spread, right? And then this price here, it's like an auction price. This is what you see on the screen. This is where the transaction actually took place. So in order for that transaction to take place, these two parties on the ask and on the bid have to come together. So either this person has to say, you know what, I really want these shares, so I have to raise my price to this price to buy it. So then if that person say, okay, I'm going to raise it to 110, then those 1,000 shares get filled from this, and then the new price becomes $1.10, right? So, and then after this transaction, there is, instead of 2,000 shares here, there will be 1,000 shares left, and then this will be gone because it just was executed. So then another buyer will have to come in and say, okay, I want to buy those 1,000 shares, but I only want to offer, $1 for them. Well, then again, those two parties at this point are the spread is 10 cents, so they didn't agree. But this price is still shows on your screen because this is the last transaction that happened. And this happens all fast, but then if let's say this person say, okay, I'm going to pay you 110 for these 1,000 shares, then the price is going to happen again. The auction is going to happen at 110, and that's the price that's going to show. But if this person says, you know what, I really want to get rid of these 1,000 shares, I'm going to lower my price to meet this person. So if let's say they go, okay, I'll sell it for $1, then all of a sudden the match will happen, and then the new price that's going to show is going to be $1, right? So this happens like really fast. But what happens when the market is not very efficient, and then the company is not trading on an efficient exchange? So NASDAQ, New York Stock Exchange, they're very efficient exchanges. But Canadian Stock Exchange or OTC or TSX Venture, they're not very efficient exchanges. Many people don't know they exist, and many people don't even have accounts that allow them to buy those stocks. So they're not efficient. So because of that, there's less liquidity. And because of this, instead of trading for around a dollar, which is close to what a particular company is worth, this kind of transactions don't happen around this level, but they happen around this level. So instead of them happening at $1, they might be happening at, I'm just going to throw in the number, they might be happening at 10 cents, right? And you can see the same sort of thing right here. They're inefficient because you always have a certain number of, you always have and also another thing is that not only do you have a market that's inefficient, in those markets in Canada, I see two extremes. I see companies that are good management, they have something good, but they're complete idiots when it comes to telling their story. It's like there's almost no happy medium. They either are good and they have something and they're idiots about telling their story, or they don't have anything and their company is trash, but they're experts in telling their story. All they are is promotion, 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 and these guys, all they are is, well, the press releases are going to tell the whole story. So mostly I focus on the ones that have something, that have a good business. So I'm dealing with idiot managers that don't want to tell the story, right? And to enter the stock, I actually prefer that. If I can convince them that they need to tell a story, right? But because the market is inefficient, because the management refuses to tell the story, you have the stock that instead of trading around the market cap level here, it's trading at this level, right? So if the company still has 100 million shares, if it still has 100 million shares, now instead of trading around a market cap of 100 million, it's trading around 10 million, right? And it's not worth it. It's worth a lot more, but because there's so little liquidity, so little awareness, the sellers really have no choice but to go so low with the price to find the next buyer, right? And then so I was watching this company today that I want to get involved, and it's literally this situation here, where and I'm making up these numbers. Their market cap should be this, but the market cap is like 10% of what it should be, because the management is not doing anything. Nobody knows about them. Nobody's talking about them. So then the sellers have to trade at this level because there's no buyers. There's no new people coming in. And what was interesting to watch is that literally what happened, it was that, again, I'm making up the numbers. The stock was trading at let's say around 20 cents, right? And then somebody wanted to sell it, right, for let's say this much, but they wanted to sell a lot. They wanted to sell like 2 million shares because, I don't know, they needed something. And there was like no buyers here for this 2 million, for this 2 million, right? And so when this amount hit the market, nobody was going to come in to pay the 20 cents. They had to come down to like the 10-cent level, and they had to unload so much stock because not only this, you see, you have also more levels to this. So So you might have like 1,000 shares at 10 cents. You might have 50,000 shares, like let's say here, 50,000 shares at this level. You might have, let me move this up a little bit. You might have like, let's say 0.11, 0.12, 0.13. You might have 10,000 shares here. You might have 100,000 shares here. You might have, let's say, 500,000 shares here. So in other words, like you have more than one level. The same thing on this side. You might have, 0.22 or 0.23, and you might have 10,000 shares that wants to sell at this level. You might have 20,000 shares that wants to sell at this level, right? But if somebody comes in and says, I need to dump 2 million shares because, I don't know, because I'm getting divorced, because I need to buy a house, because of this or that, well, you look at this, you're like, there's not enough buyers, but I need to sell. So what happens is that you're going to go and you're going to sell 10,000 shares at this price, right? So now the price is gonna drop to 13 cents because you're gonna take care of these, but you only sold as many shares as were available there. Now you still have more shares to sell. Now you're gonna take all of these and you're gonna sell 100,000 of these shares, and now you have to go down to 12 cents to take out all of these. So you take them out. You still have more shares left to sell. Now you have to go down to 11. Now you have to take 11 to take out these shares, and you're still not done. And you have to keep going. You have to keep going until maybe you take out everybody. And then the next thing you know, the price that shows on the screen is 10 cents, right? So let me move this down again so you can see. And at the beginning of the day, the stock, let's say, was 20 because there was no significant seller. But in one day, the stock went down 50%. And this happens all the time when the company doesn't do anything to expose itself. Now, of course, the reverse happens when the company starts bringing in new investors and start creating awareness. Then what starts happening is that now, so let's say this particular company now all of a sudden is like, you know what, we need to do something, and we want to tell our story, we want to expose it to more people. So now the same situation is, let's say this 2 million shares is gone because that 2 million shares sent the stock price to 10 cents. Now more people are coming in and somebody is like, well, I want to put 100,000 into it, or I want to put 10,000 into it. And then so you're like, okay, well, maybe at first there is some people that will sell you 10,000 shares at 11. So then you're like, if you have competition from others, then you're like, well, I better get this 10,000 shares, because if I don't get this, somebody else is. So then you're like, oh, okay, I'm gonna offer 11 cents for it, and I'm gonna take all of this out. The new price that shows is 11, but you're like, but this stock is worth $1. Like, I want to buy more shares. So then all of a sudden you're like, well, there's another block available at 50 cents. I want to buy all these 20,000 shares. So then you're like, I want to buy all these 20,000 shares, and I'm going to raise my price to 15 because I want to get this, because if I don't get this, somebody else gets it. Then boom, the price goes up to 15 cents, right? So then this gets wiped out. And then somebody else is like, oh my goodness, the price is going up. I can only see that there's 10,000 shares available. I better come in and be like, I want to get those 10,000 shares. I want to wipe this out. Boom, gone. And then the new price on the screen that shows is 70 cents. And when the company gets enough exposure and enough volume, which is their job, by the way, then the company should start trading closer to what it should be, right? If they do their job and make the market a little bit more efficient, right? So then, but because you came in when the stock was, let's say, 10 cents, during the time where barely anybody knew about it, you were the first one in, then you potentially can make 3 times, 4 times, 5 times, 10 times your money just by the company doing its job and making the market more efficient, right? So that's why I like looking for companies that are horrible at this, and that's why I like adding value. In other words, helping them get more efficient, helping them get more awareness, and helping them, get the pricing more efficient. And I'm not talking about trying to send the stock to, let's say, $10, which would be way more than the value, way more than the value. I'm talking about taking something that is crazy undervalued and bringing it a little bit closer to the area of it being somewhat reasonable. So I hope this explains a bit, and that's literally what the company that I'm interested in getting involved, exactly this is happening. They're trading around this level because they haven't done the work. They're trading on an inefficient market. Barely anybody knows about them. And in one day, I saw the stock price drop 50% because somebody needed to exit. And so when I do get involved, the first people that are going to know about this are the MCE subscribers because they're paying me, right? They're the first ones that are going to find out about this opportunity after they get whatever shares they want. And if this results in the stock price going, I don't know, to 30 cents, they will triple their money. If this is the scenario that's going to happen, then the next people that will know about this stock are the people that subscribe to my free mailing list. So you can sign up to the free mailing list. You're going to be second to find out about something like this. And then the third people that are going to find out about it is people on YouTube, right? So that's the order. MCE subscribers get first because they pay for the information. Subscribers to my email list, they're going to find out second, and the people that are on YouTube and everywhere else are going to find out later. Anyway, I hope this helps. This is how the stock moves, especially in the microcap space. It's not some magic thing happening on the screen. There's actually asks. There's actually asks that are eliminated, and then that pushes the stock price higher. And if the stock price goes down, the bids get eliminated because the sellers have to come down to the bids to get what they want to accomplish, which is to sell the block of shares that they want to sell. So that's it for this video.